Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast, presented in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. And before we jump into today's episode, I just want to thank everyone that supported us on Patreon. Your support really helps keep this show going. So, like a runaway escapee, all citizens and green card holders from the United States that live in Canada cannot escape U.S. taxation. Even if they lived in Canada their whole lives, they still need to file an American tax return. On this American return, they will be required to disclose all of their worldwide income for each individual year, including employment in Canada and what we're focusing on today, their investments. This is an extremely difficult topic to navigate, so join us today as we make sense of what is going on and ways to avoid these tax headaches. This is, of course, a very complicated topic, and it's recommended that you speak to a professional accountant to navigate these issues further. So, to kick things off, I'd really like to start by saying just how annoying these regulations are. They are extremely confusing, and many financial professionals may not even be aware of them and recommend products that have negative tax consequences. Self-investing dual citizens especially need to watch out because no one will stop you from falling into any of these traps. So what's happening here is that basically every American citizen living in Canada needs to complete an American tax return on top of their Canadian return. Depending on the financial products that they choose, this can lead to varying amounts of soul-sucking paperwork, higher accounting fees, and in worst case scenarios, an amount owed to the IRS. These same US tax rules also limit the benefits of using very important financial products that many Canadians use to achieve their financial goals. And unfortunately, the tried and tested model of closing your eyes and hoping that the problem goes away will also not work in this situation. There is legislation that's already been passed that requires all non-US financial institutions to report any individuals that meet tax criteria to the IRS. There can also be fines and penalties in extreme cases. Thankfully, there are steps that dual citizens can take to sidestep parts of this legislation. By following a couple basic rules, you can avoid some really annoying tax issues from popping up. So to first understand what's going on, we need to really look into what's happening behind the scenes. So all dual citizens need to claim their worldwide income on their American tax returns. This includes taxable income, self-employment income, interest, dividends, capital gains, and more that are earned in Canada. This also means that taxes are calculated against this income on the American return. Thankfully, there's a tax treaty that exists between both countries to prevent double taxation. On top of that, Canadian taxes are typically higher than American taxes, meaning that often no American taxes are owed. However, there are certain investment choices that can lead to US taxes owed and add requirements to fill out complicated paperwork that can also lead to higher accounting charges. In addition, all dual citizens must declare any accounts that they have authority over and that have over 10,000 USD at any point of the year. Overall, what we really want to do is keep the amount of income of the USD return as low as possible and to minimize paperwork. To do this, we need to plan in advance and avoid certain pitfalls. So first of all, the biggest trap that dual citizens fall into is using specific types of registered accounts. And the offenders here are tax-free savings accounts, registered educational savings plans, and registered disability savings plans. There are also special rules that come to registered retirement saving plans, which we'll talk about in a few minutes. So typically these registered products have special rules with how returns are taxed, right? Tax-free savings accounts do not charge taxes at all, while RESPs and RDSPs charge taxes when the funds are withdrawn and not when the returns are actually incurred in the account. And the big benefit with this feature is that you have returns that are growing on non-tax returns and typically leads to greater returns for the individual. However, the US government does not recognize these tax benefits. So dual citizens are not taxed on these returns in Canada, but they will count as income in the United States. And this can also lead to double taxation in some situations. So the elimination of this tax deferral status in many cases eliminates the benefits of using these accounts. And to make things even more complicated, government grants, such as those received in RESPs, count as taxable income. Now, accountants also debate whether these accounts are designated as foreign grantor trusts. And this is unfortunately an issue that really hasn't been clarified by the American tax authorities. But if it is classified as one, then you would also need to file a series of complicated trust forms for each individual account. Now, the decision whether or not you need to fill out this paperwork really depends on the accountant that you have, but in many cases, to err on the side of caution, they will complete that paperwork. So the general rule of thumb for most dual citizens is to avoid using tax-free savings accounts and RESPs, or at least to seek professional advice before you choose to use them. So for RESPs, one way that you can easily get around these rules is to have a spouse or a direct family member hold the RESP if they are not a dual citizen. Other individuals can also hold RESPs too. However, some additional benefits that are offered in RESPs may be lost. And unfortunately, the major recommendation for tax-free savings account is really just not to have one. If your partner has additional room, they can hold the funds, but there really is no other option for it. And when it comes to retirement plans like RRSPs and RIFs and other similar types, the IRS does recognize the tax deferral status of these invested funds. So they don't fall under the same faults as the other registered plans. However, the tax deferral benefit of new contributions to RSPs do not reduce your taxable income on U.S. returns. So dual citizens need to be careful when they make large RSP contributions, as in some cases, this can cause a foreign tax credit to be less than what is actually owed on American taxes, leading to an amount that's owed to the IRS. And being realistic about this probably would not affect most individuals. However, it's always a good idea to be conscious about it. And the last big pitfall for dual citizen investors is something called passive foreign investment corporations, or PFICs for short. This policy was designed to prevent U.S. persons from deferring taxes on passive income earned through non-U.S. corporations or converting their income to capital gains that are taxed at a preferential rate. However, many Canadian investments fall ajar under these rules, including popular Canadian-issued mutual funds, exchange-traded funds, and real estate trusts. And what this means to you is that these are taxed at a higher rate than regular investments in the United States, and also a special American form needs to be completed for them. So to sidestep this issue, what you can do is you could avoid holding certain types of pooled funds that are issued on Canadian stock exchanges if they are not in your RRSPs. Also, you can find specific Canadian investments that are compliant with the PFIC rules. And other ways that you can get around these rules is to actually use physical stocks or bonds, or you can use ETFs that are issued on American exchanges. So overall, what we see is that the solution for dual citizens that are living in Canada is really one of avoidance, which is of course very unfortunate because many tax benefits that are offered to Canadians are essentially sacrificed. And you could also see how important it is to understand what kind of solutions are available to dual citizens to avoid certain issues in the future. Now, the future is uncertain with how these programs will be changed, but what we really hope is that certain registered plans will become more acceptable and more compliant for dual citizens living in Canada. So as always, thank you again for listening to Simple Money Podcast. If you're enjoying the show, please consider sharing with a friend or family, and please rate us on whichever podcast provider you're using. Thanks again for listening, and talk to you soon.